Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:03 a.m. here, Pacific time, June 20th. I hope everyone had a good Juneteenth holiday. Also, give a shout out to the U.S. men's national team for knocking off Saudi Arabia 1-0 to advance to the quarterfinals in the Gold Cup. We also have the Stanley Cup champion, Florida Panthers, keeping the Stanley Cup in the US of A. So congrats to the Panthers. And with that, we'll kind of kick it off. Shortened week this week because of the aforementioned holiday, Juneteenth. But we had a Fed meeting. Wasn't the most exciting. They sat on their hands, but we'll get into that in a bit. Let's just take a look at the markets. Markets are quite sanguine considering all the geopolitical turmoil going on in the Middle East. Looking at the S&P, it's up a whopping 6 basis points on the week, so not much really to report there. If you want to dig in and look for some more color, I mean, the biggest moving sector was healthcare, down about 2.4%, and the best performing sector was communication, financials up about 1%. Communication services also up about 1%. So not a whole lot of movement, and not a huge amount of sectoral dispersion either in stocks. You know, just looking across the board, even you go look at the Russell 1000 growth down 12 basis points, Russell 1000 value up 38 basis points. I'm going to call that just, micro gyrations of the stock market. Nothing really to report, which is interesting given the, where we are in the world, in the kind of all of the things that are going on between trade, global conflict, the big beautiful bill. All of these things are happening and stocks are just sitting pretty, haven't really moved much, incrementally up. Going over to fixed income land, you just kind of grinding out the carry and making a little bit of return there. I mean, you got the ag up 31 basis points on the week. Yes, the 10-year treasury rallied slightly on a week-to-date basis, a whole 3 basis points, which isn't what I would call significant given the kind of the risk-off situation in the global geopolitical realm. And I think that that's something we at DoubleLine have been talking about for a while, how, these conflicting currents of the fiscal overhang in the U.S. meeting, the previous, let's call it, epoch's concept of the U.S. dollar being the safe haven, those are in conflict right now. So even though we saw a bit of a rally with the conflict going on between Iran and Israel, we didn't see a massive rally that maybe you would have expected. So a whole 3 basis point rally, which led to the ag being up about 31 basis points. Best performing sector there, interestingly, was high yield, up about 44 bips. Governments up about 30. Investment grade corporates up about 40 as well. So, those are the sector returns. So positive week in fixed income. I also think that the Fed doing nothing kind of maybe is injecting a bit of stability into the bond market, as bond investors are just kind of accepting that the Fed is unlikely to cut much until the end of the year. And even then, maybe they'll cut once or twice. And we'll talk about Jerome Powell's presser, but these Fed governors, they're really in a complicated scenario because they're kind of like caught between, is there going to be recession? We're going to cut. Are we going to kill the inflation boogeyman and we're going to cut? And they're just pretty happy to sit still and do nothing. So last but not least, we moved to commodities, and the commodity market rallied. Not surprisingly, the energy sector was the best performer, up over 5.5%. As we sit here right now, WTI crude is at $75, Brent crude is at 77, and I mean, it makes sense. There's this geopolitical risk premium. Over 20% of the world's oil supply goes through the Strait of Hormuz. There's uncertainty regarding whether this conflict is going to escalate into, to disrupt oil flow through that strait, and no one really knows what's going to happen. I mean, hopefully cooler heads prevail, and this situation is able to de-escalate, but it's just very tough to predict what's going to happen when missiles are flying through the air, and it's just definitely a high risk scenario, and you have to wait and see what happens. So it does make sense that oil's up. That said, if you look at fundamental forecasts, if this conflict wasn't there, I mean, everybody's still predicting a $60 or below oil price. So, the prices we're seeing are definitely due to the conflict happening in the Middle East. Wrapping up with gold, interestingly, was down on the week. So gold's currently trading about $3,370, and that's another interesting thing. The flight to gold hasn't really happened. The dollar actually rallied on the week slightly, interestingly, up about 50 basis points, while Bitcoin dropped about 2%, sitting at 103,700. And that kind of wraps up where the markets are for the week, unless you have something to add, Mr. Kimbrough.
Yeah, I just wanted to reemphasize. I mean, you summarized all that and showed all the chop effectively we had all week. We really didn't really go anywhere. Kind of earned your carry. Smallish rate rally, but the one relief valve we had and all the kind of craziness going on in the world is the oil market, and that definitely did show up there. So it was just interesting to see so little vol everywhere except for there. But I guess it makes sense given the regional conflict happening over there.
Yeah, so let's kind of jump into the economic stuff to keep on people's radar, and then we can have a discussion about the Fed and then tell people what to look out for next week.
All right, let's do it here. This was I'd say the most important economic data set we got this week, absent the Fed. This was the retail sales report, came out on Tuesday for the month of May. Somewhat interesting report here. I'll give you a little details on it. The headline print came out at a weak negative 0.9%. That was 0.3% below the estimates, 0.8% below the prior. We also got the retail sales ex auto and gas for the month of May. This came in at a stronger than headline, a negative 0.1%. That was 0.4% below the estimates and 0.2% below the prior. And lastly, we got the retail sales control group. This is the metric that's used in the GDP calculation. This came through at a positive 0.4%. That was 0.1% above estimates and 0.5% above the prior. Just very interesting to see this report and see a 1.3% spread between your headline number and your control group. Let me just give you a little color to help explain that. The vehicles and parts came through at a very weak negative 3.5% month over month. It contributed negative 66 bips to the headline print. Number can be a little volatile, but we'll credit a little of that to tariff-related impacts. That really did explain the big difference between the headline number and the ex auto and gas. But the retail sales control group, that takes the headline number and strips out four categories. Strips out food services, auto dealers, building materials, and gas stations. And those four categories, there's 13 in total, but those four categories were the largest negative detractors to the headline print. So, your biggest down movers, that's the reason you have such a big dispersion. But looking at these numbers, I mean, those big down movers were, again, vehicles and parts, building materials. I'm going to lump both of those in and say we can have a little tariff-related vol. I'm not going to overreact to those. They have been relatively weak over the last 6 months, but we'll see where that goes in the months to come. Gasoline stations up until this month, which we just talked about, gas has been falling. And as that falls, it helps consumers, free up a little money to spend elsewhere. So that being down isn't exactly a negative in my book. And then lastly, eating and drinking, the services category. It's our loan service category that gives us a little look into service consumption. That was down 0.9% this month, but on a 6-month annualized basis, it's up 4.2%. So this was just kind of a 1 month. I'm going to call this a 1 month lull. We'll see how it comes through next month. But all in all, retail sales, the market didn't care too much about it this week. It kind of shrugged it off and was more concerned with geopolitical risks. So we'll move forward from this and just say retail sales are a little softer on trend, but we'll see where we go in the months to come. Moving forward, also on Tuesday, we got import price index for the month of May. Not a lot to see here. The month-over-month print came in flat, 0.0%. That was 0.2% above estimates and 0.1% below the prior. This resulted in the year-over-year number also coming in at 0.2%, a small uptick from a prior of 0.1. Again, all in all, these numbers are still reflecting the overall disinflationary impulse coming from it, although you don't want to overstate that, as these numbers don't include the impact of tariffs in the calculation. So for now, we'll just say it's still good to see on the inflation side, but that does not clear up future tariff issues on the CPI PPI side. Also on Tuesday, we got industrial production for the month of May. This also came out soft at negative 0.2%. This is kind of steady. She drifts. We're continuing not to see much traction in the manufacturing space here. Capacity utilization came in 77.4%. That was 0.3% below estimates in the prior. I'm going to say there's a little sign of life in this report. Just want to mention it just because I mentioned vehicles and parts in the retail sales. But vehicles and parts within this report, we had month-over-month production up 4.9% and capacity utilization hitting an 11th-month high. You can argue those are, explained by a pause in tariffs and corporations ramping back up production while they can. We'll see how that continues to develop. Moving forward to Wednesday, we had initial jobless claims for the week ending June 14th. This came in right in line with estimates at 245K. The 4-week moving average increased to 246K, highest since August 2023. That trend is, the uptrend continues. Same with continuing claims. For the week ending June 7th, came in at 1.945 million. It's 4K above estimates, 6K below the prior. Again, same thing here. Continuing to make new 4-week moving average highs. I'm going to say that this data continues to reflect it's not falling off a cliff, but it's still reflecting a slow degradation. Also on Wednesday, we got the big FOMC non-decision. The upper bound stayed unchanged at 4.5%. We can talk about that a little after covering up the week here, but we'll come back to that later. And then it wrapped up the week with Friday today. We got the leading economic index for the month of May printing at negative 0.1%. Look, to take the big takeaway from this report is it now is giving a recession signal again. They revised their prior reading. And while the report is now giving a recession warning, the conference board does indicate within there that they are not projecting a recession. They're just expecting significantly weaker growth in 2025 compared to 2024. And that wraps up this week. We can kind of head on back to the Fed meeting, but
finish it up with the good old broken clock, the LEI. It's been wrong, but hey, man, the old adage, a broken clock is right once in a while. When that So we'll see what happens. Definitely, I think it's a good summary, Mr. Kimbrough, and I'd say it's a neutral to soft week. The overarching theme of the
I'd
data,
agree.
something to keep an eye on. Definitely, if you're a bear, you're probably like, oh yeah, this is giving you that confirmation bias that things are becoming more bearish. And if you're a bull, you could probably brush this off because I don't think there was like really strong data in any direction, but definitely slightly soft.
All week we seemed to trade away from any economic data that happened. Nothing really seemed to react to the releases. It was more just news and headlines on the conflict and where that direction is going to go in the Middle East.
Yeah, I agree with you. I think that was the headline grabber, and it was forefront of every market participant's mind, because this is a big scenario and there's a lot of uncertainty regarding what can happen. But that said, I mean, the stock market's flat. The bond market incrementally rallied, the dollar incrementally rallied. So I think that, given all of that, maybe it captivated people's attention, but there could be a bit of just like summer, stuff going on where market participants are like maybe not really trying to trade around this stuff too much. They're just trying to sit tight, for a bit. I don't know.
No, similar to that, that's kind of the aspect. That's kind of the perspective the Fed is taking. Jeffrey Gundlach was on after the Fed spoke, and he referred to this as a wait and see meeting. This is, one of those, let's just continue to digest data, continue to take in all the data points around us that are happening, and just acknowledging we're not in a bad place right now. Things maybe are slowing down, but at one point, Powder in the meeting was in the Q&A was mentioning that the economy is solid, that we're having a labor market that's stable, inflation is moving down. The right thing to do is to kind of just continue to sit here. We're making more progress. Let's wait and see how tariffs come through in the months to come, because people do expect there to be a rise in inflation on the back of tariffs.
Yeah, that's my big takeaways from the Fed meeting, and let's just talk about the WIRP right now. Right now, that the interest rate probabilities are predicting 2 cuts by year end, but that's once again the 2 cut is like split between the no cut camp and then the 4 cut camp. who like think there's going to be a slowdown that warrants a bigger cuts than the camp that's just like, no, we're going to do nothing. So we'll have to wait and see what happens. But I think that's important to remember. It's not like it's everybody thinks there's going to be two cuts. There's really these two groups, and you can see that in the dot plots of the Fed as well, where it's kind of split between two camps, the cut camp and the kind of no cut camp. And I think that comes down to your point, Mr. Kimbrough, that the Fed thinks there's going to be inflation because of tariffs. They think somebody's going to have to pay the tax. Fed Chairman Powell said it himself. He thinks that somebody's going to have to pay it. It's going to be a combination of, producers, retailers, and consumers, and it's just going to be a combo of all the above. And they think that inflation is going to flow through, and we'll see what happens. I don't know what's going to happen. I don't think anybody really does, but the Fed is very happy to sit on their hands and wait, because I think that the risk from Jerome Powell's perspective is he has less than 1 year remaining on his term, and he doesn't want to be known as the Fed governor who let the inflation boogeyman get loose, and he just wants to kind of ride off into the sunset, in my opinion, with inflation in the bag. And I think he'd be willing to frankly risk a weaker labor market and a weaker economy because he believes that the Fed's tools are strong enough to revive growth, in that scenario. So that's my point of view. And I think that they're very happy to sit there. The chair himself said, he doesn't think rates are highly restrictive. He thinks they're moderately restrictive at best. So that's his point of view.
Well, he doesn't want to put himself in a position where he's going to be like, the inflation from tariffs is going to be transitory. We don't need to repeat that again, and with that level of confidence. So it's a wait and see. Just be patient and see what happens.
I agree with you, and I'm just going to highlight, I think that for people that are more interested, want to spend some more time digesting the Fed meeting, get some different points of view, check out Mr. Goodluck's CNBC interview. We have that on our DoubleLine channels, and check out Ken Shinoda's discussion as well, and you'll get some more color. But that's really all I have to say on the matter.
Yeah, I'd say that kind of wraps it up for the week. I'd say.
Yeah, definitely. What should our listeners take a look for next week?
Let's see what we got on deck for next week. It's a bit fuller of an economic week. Let's see, on Monday we start off with S&P Global. We get PMI data, manufacturing and services. Both are estimated to come in slightly in the expansion territory. We got 51 for manufacturing and 52.9 for services. On Tuesday, we get S&P Core Logic, the housing price appreciation numbers. No estimates yet on my screen, but last month we had the year-over-year number for the 20-city measure coming at 4.07, and the month-over-month measure was a negative 12 bips. So we'll see if that stabilizes or resumes its uptrend. Also on Tuesday, we get Conference Board consumer confidence numbers, estimated coming at 99.4, trying to still claw back from the local low we hit in April. On Thursday, we get the third estimate of Q1 GDP, estimated to be unchanged at negative 0.2%. Also on Thursday, we get more manufacturing data. We get the durable goods orders. We get a bit of a spike in the estimate here, positive 7.5%. We'll see how these numbers come through. The cap goods orders, non-defense ex-air is estimated to come in at negative 0.5. So just nothing too crazy in these numbers, kind of still softish in the volatile headline number. Also, we get our weekly jobless claims numbers expected to tick up to 247K for initial claims. We'll see where continuing comes through. And finally, we get Friday, a big data set here. We get personal income and spending for the month of May. Personal income is estimated to come in at 0.3% versus prior 0.8%. And we get personal spending is estimated to come in at 0.2%, right in line with the prior. Just real quick, last 2 months, we've had pretty big prints for personal income, and this has been on the back of transfer payments. It's been Social Security related. So that's estimated to be normalizing the data, and we'll see where those actual income numbers come. And then Friday, again, we have PCE. See the core number, the core number year over year is estimated to come in at 2.6%. It's a slight uptick from the prior. This is base effects, as the month over month figure is estimated to come in at 0.1%. And we know these estimates are pretty accurate at this stage of the game. And that wraps up the week that we got for on deck for next week.
Yeah, I think those are some good things to look at. I wouldn't be surprised if that housing data was a little softer even than the prior minus 12 basis points, but we'll have to wait and see. And then also GDP, I don't know, you take it with a grain of salt. The minus 0.2, that had a lot to do with the odd import-export stuff, and even the Fed the Federal Reserve economists, their 200 PhDs are kind of throwing out first quarter GDP. So I think first and second quarter GDP are going to have to be kind of lumped together to get a sense of what the economy did in the first half, frankly. But we'll just have to wait and see. I think that was a
it's you can't overreact to either one of those data points. You got to smooth it out.
yeah. I'm aligned with you there. So that wraps it up for the week.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital, and make sure to check out those videos of Mr. Gunlock and Mr. Shinoda. Thanks for tuning in, and I hope everybody has a great weekend.
Yeah, thanks, everybody. Take care.